Welcome to Greenleaf Now, where we go over everything commercial real estate and what's happening in the Greenleaf world. We're going to talk about a little bit of investing all the way through operations. And today we're talking about when should you reinvest in an asset. There are lots of analysis that can go into this, but most of the analysis we see out there too is around buying. Popular stuff is buy and renovate and rehab. That method, we've used that for years on buying our commercial assets and multifamily assets before. There's also the idea of, hey, you could buy a deal, you could renovate one or two units, kind of test it out, and then sell it based on that new valuation. The option of really doing these big cash out refinances has dwindled over the past couple of years, and especially recently. So we want to look at an example where we bought a deal back in 2017. We bought it without doing a whole lot of rehab. We kind of purchased it, it was operating, and we kept it at the same condition, knowing that the area would improve that it is in. Now, fast forward 5 years later, almost 6 years later, the asset we have is now, for the most part, underperforming the area that it's in. Our rents are around $750 to $850 a month, whereas the market has rents that are in the $1,000 range for a one-bedroom, and up to $1,500 for a townhome and over $2,000 for a single-family home. We have 2- and 3-bedroom townhomes at this asset, and they are lower than almost anything else in the area. Our main reason they're lower, though, is the condition. We have strong retention at this community. We're at 88% retention for the year, so that means almost 9 out of 10 people, when their leases come up, they are renewing because they're getting a rental rate in that $750 to $850 range that is below pretty much everything else in the market. Those market increases have been driven by new apartments coming online, renovated homes showing up, and even new construction in the area. This is on Memorial Drive corridor in Atlanta, so there's been a ton of development over the years that have happened here, and it has shifted dramatically. So the biggest thing holding us back on capturing higher rental rates is our condition. And it is townhomes, but it was built in the 1970s. We have original cabinets. A lot of the times we have HVACs that are older, appliances that are older as well, and original condition and design layouts. So there are some challenges that you face with that. So the question comes into, when should we put money into renovating these units? The deal itself, we have 10-year fixed debt that goes through 2027. So we do not have a whole lot of opportunity to refinance out this position or gain capital in that manner. And we are looking to hold it long term. So the opportunity we're looking at here is with a market that's greatly improved. Now, other part of that improving market is we've seen all of our costs go up as well. Our taxes are up significantly. We have insurance costs that are up over 200% over a 3-year period. And we have our maintenance costs just on recurring overall items that has also increased. So overall, our total cost pool has grown about 20% over the past 18 months. So we are seeing rising costs, and we're not seeing revenue that offsets that with the condition we're currently in. Therefore, we're looking at how much do we need to invest to bring the rental rates up to cover the cost increases that we've seen. And where we're at right now, we have a test case we did first coming out. We had a unit that was a townhome unit. They're all townhomes, though. $830 a month in rent. And we spent about $17,000 upgrading this unit. That was everything from all new windows. We put in new sliding doors for the patio. We replaced all the cabinetry throughout the whole unit. So that's the bathrooms and the kitchens. We redid a lot of the subfloors so that it just felt more stable, and that enabled us to put down a nicer, we used LVT flooring. And then we put all new carpet in, and we painted the unit, and we have new hardware. So it's not a full renovation. We didn't take things down to the studs and redo electrical and plumbing, but we upgraded what was currently in there. And that total cost took us about 5 weeks, and it cost us $17,000. Now, the payback period we're going to receive on that is we rented this unit for $1,260 a month. So we saw a $430 rental rate increase during that time period. So if we take our total cost of $17,000 and divide it by the $5,160 that we receive each year from that added rent, it gives us a payback period of 3.3 years. Now, this is a gross number. So this is just gross spend versus gross revenue gain. Now, if we did that, we added $5,000 a year on that one unit. If we do that 6 times, we will cover the cost increases we've seen. And we're not fully renovating an asset. We're not doing huge workload here. We're only talking about 6 of the units. And that should cost us on average about $15,000 or a $90,000 investment. The asset generates that in free cash flow. So we're looking at taking our free cash flow over a 12-month period and investing it into specific units to drive our revenue up and cover not only our increase in costs, but also improve our overall cash flow. Going forwards, we expect this to reduce our repairs on these specific units, and we'll then assess going forwards if we should continue to do the one-off updating or should we look further and do a full renovation on the asset to really capture the higher market rents that are out there. Thanks for tuning in. Please let us know if you have any questions.